For decades, Japan's bond market was considered boring, predictable, stable, almost irrelevant. Yields barely moved, volatility was non-existent, and investors stopped paying attention. That complacency is now gone. Japan's bond market, the largest in the developed world, is beginning to crack. Not suddenly, not spectacularly, but structurally. And what makes this moment dangerous is not what's happening inside Japan. It's what happens after Japan stops functioning as a stabilizer for the global financial system. Today we're going to explain what's breaking in Japan's bond market, why it's happening now, and why this matters far beyond Japan's borders, including your wallet. Why Japan's bond market matters so much. To understand why stress in Japan's bond market matters, you first have to understand how unusual that market is. Japan doesn't just have a large government bond market, it has the largest sovereign bond market in the world. Japanese government bonds, JGBs, represent the financial backbone of Japan's entire economic system. They are not optional assets. They sit at the core of pension funds that support an aging population, insurance companies matching long-term liabilities, bank balance sheets used as collateral monetary policy transmission. For decades, JGBs were treated not as risk assets, but as infrastructure. This stability did not occur naturally. It was engineered. After the collapse of Japan's asset bubble in the early 1990s, the country entered a prolonged period of stagnation and deflation. To prevent a depression, the Bank of Japan adopted policies that were unprecedented at the time. Near-zero interest rates, massive bond purchases, direct intervention across the yield curve. Eventually, the BOJ went even further. It implemented yield curve control, effectively setting a cap on long-term interest rates. This meant that prices no longer reflected supply and demand. They reflected policy. At its peak, the Bank of Japan owned more than half of all outstanding JGBs. That level of intervention has consequences. Liquidity deteriorated, trading volumes collapsed, price discovery disappeared. The bond market functioned, but only because the BOJ stood behind it at all times. For years, this was seen as a feature, not a flaw. Volatility vanished. Borrowing costs stayed low. The system looked stable, but it was stable only because it was being held in place. Japan's suppressed yields didn't stay in Japan. They pushed capital outward. With no return available at home, Japanese investors sent trillions abroad. This helped lower global interest rates, support U.S. Treasury demand, inflate asset prices worldwide. In effect, Japan's bond market became a global shock absorber. It absorbed excess debt and exported liquidity. That role is now being questioned. How the pressure built and why it's showing now. No system can suppress risk forever. Eventually, reality reasserts itself. In Japan's case, pressure accumulated slowly, and then all at once. For decades, Japan struggled with deflation. That made zero rates defensible, but inflation has returned. Not at extreme levels, but persistently enough to matter. Even modest inflation makes zero-yield bonds toxic in real terms. Suddenly, pension funds faced guaranteed losses. Insurers struggled to match liabilities. Savers felt punished. This undermined political and financial support for permanent suppression. Japan's loose monetary policy weakened the yen dramatically. A weak currency can support exports, but it also raises import prices, shrinks real wages, increases public dissatisfaction. At a certain point, currency weakness threatens domestic stability. That point arrived faster than policymakers expected. As global interest rates rose, defending yield caps became increasingly expensive. The BOJ had to buy more bonds just to prevent yields from breaking higher. This created a paradox. The more the BOJ intervened, the less liquid the market became. The less liquid the market became, the more unstable it grew. Bond trading sometimes froze entirely. Price signals vanished. A bond market without prices is not a market. This is not a short-term imbalance. It is the result of decades of policy distortion colliding with changing global conditions. The BOJ now faces an impossible choice: maintain control and sacrifice the currency, or loosen control and accept volatility. Either option ends the era of artificial stability, and once that era ends, markets must reprice risk from scratch. The BOJ is cautiously stepping back, allowing yields to move, reducing purchases, testing market tolerance. These are small moves, but in a system built on absolute control, small moves have large consequences. This is why investors are paying attention now. Not because Japan's bond market has exploded, but because the mechanism that held it together is no longer absolute. From domestic stress to global shock. For years, Japan's bond market problems were treated as a local issue, a uniquely Japanese problem, a side effect of demographics and stagnation. That framing no longer holds, because Japan's bond market does not exist in isolation. It is deeply embedded in the global financial system, and as pressure builds at home, the consequences travel outward. For decades, Japanese investors were forced to look abroad. With yields near zero at home, pension funds, insurers, and banks searched for return elsewhere. This created one of the largest and most persistent capital flows in modern finance. Japanese money flowed into U.S. treasuries, corporate bonds, European sovereign debt, global equity markets. This wasn't speculative behavior. It was structural. Japan's bond market pushed capital out. Now that pressure is reversing. As Japanese yields rise, even modestly, the calculation changes. Domestic bonds suddenly offer higher nominal returns, no currency risk, lower regulatory and political uncertainty. For large institutions, that matters more than yield chasing. Capital doesn't need to rush back to cause damage. Even a gradual reallocation reduces demand abroad. And in global markets built on tight margins, reduced demand is enough. The United States is the primary destination of Japanese capital. Japan is one of the largest foreign holders of U.S. government debt. If Japanese institutions slow purchases or begin trimming holdings, the impact is immediate. Treasury yields rise, auction coverage weakens, volatility increases. And because U.S. Treasuries are the global benchmark, this pressure spreads everywhere. Higher U.S. yields tighten financial conditions worldwide. This is not a temporary risk-off event. It is a structural reallocation driven by policy normalization in Japan. Those shifts don't reverse easily. Once capital is repatriated, it tends to stay home, and that makes the impact persistent. The most underestimated channel of risk is the currency, specifically the Japanese yen. For decades, the yen served as the world's cheapest funding currency. Global investors borrowed in yen at extremely low rates. They converted those funds into dollars or euros, and they invested in higher-yielding assets. This strategy, known as the yen carry trade, became a pillar of global liquidity. It suppressed volatility, supported asset prices, amplified leverage, and it depended on one assumption, that Japanese rates would stay low forever. That assumption is now under threat. As Japanese yields rise and the yen becomes more volatile, carry trades become dangerous. Borrowing costs increase. Currency risk explodes. Leverage becomes unstable. When carry trades unwind, they do so quickly. Assets must be sold, positions are closed, liquidity vanishes. This is how localized policy shifts trigger global market stress. If Japan chooses to defend the yen aggressively, it has limited tools. One of them is selling foreign assets, primarily U.S. treasuries. Even small-scale sales send powerful signals to markets. They suggest Japan is prioritizing domestic stability. Global liquidity is being withdrawn. The era of automatic support is ending. Markets respond sharply to those signals. For decades, Japan exported stability. Its suppressed yields and weak currency absorbed risk. Now, it is exporting volatility instead. Not intentionally, but inevitably, because the policies that held volatility down are being dismantled. Why this hits your wallet? Most people will never buy a Japanese government bond. That creates a false sense of distance. But bond markets don't operate in isolation. They sit at the base of the entire financial system. When Japan's bond market begins to reprice, the impact spreads through interest rates, currencies, and asset valuations worldwide. The repricing of the risk-free rate. Japanese bonds help suppress global yields for decades. As that suppression fades, the global risk-free rate moves higher. That matters because nearly everything in finance is priced off that baseline. Higher risk-free rates mean higher mortgage rates, more expensive car loans, rising credit card interest, higher borrowing costs for businesses. Even if local central banks don't raise rates, global funding costs still rise. That pressure reaches consumers quietly, through monthly payments, not headlines. Asset prices adjust slowly, then suddenly. Stocks don't fall because companies stop operating. They fall because discount rates change. When bond yields rise, future earnings are worth less today, valuations compress, leverage becomes dangerous. This process often begins invisibly. Markets remain calm, indexes stay elevated. Then one adjustment forces another, and suddenly risk assets reprice all at once. Retirement savings and pensions. Long-term portfolios are especially exposed. Pension funds and insurers depend on predictable bond markets. Japan's shift introduces volatility into assets once considered stable. That volatility affects pension funding ratios, insurance reserves, long-term savings performance. These effects don't show up immediately. They show up years later, when returns disappoint or contributions rise. This is not inflation shock. It's a financing shock. Costs don't spike overnight. They grind higher, and grinding pressure is often harder to adapt to. Why this time is different? Japan has faced bond market stress before, so why does this moment matter more? Because the system has changed. There is no replacement stabilizer. In the past, the Federal Reserve could ease aggressively China recycled surpluses into global assets. Japan exported cheap capital. Today, all three are constrained. The Fed is fighting inflation. China is focused inward. Japan is withdrawing. There is no obvious backstop left. Debt levels are much higher. Global debt is far larger than in past cycles. Higher rates now have non-linear effects. Small yield increases create disproportionate stress. What once would have been manageable adjustments now threaten solvency. Markets are built on assumptions that no longer hold. For decades, markets assumed cheap money was permanent. Volatility could be suppressed. Central banks would always intervene. Japan's bond market was the clearest example of that belief. Its unraveling forces a reassessment of all of them. This is not a crash scenario. It's a transition. And transitions are dangerous because they lack clear timelines, create false calm, encourage complacency. When structural shifts happen, they rarely announce themselves clearly. There is no single indicator, no definitive headline, no moment when everyone agrees that this is it. Instead, stress reveals itself through patterns. And Japan's bond market will send those signals long before any crisis becomes obvious. The most important thing to watch is not how high Japanese yields go, but how they move. A stable rise is manageable. A volatile rise is not. If yields begin to swing sharply, break through previous informal ceilings, or require frequent central bank intervention, that suggests control is weakening. Markets can live with higher rates. They struggle with uncertainty. Another critical signal is the gap between what the Bank of Japan says and what it does. When central banks are confident, words and actions align. When they're not, intervention becomes reactive. Watch for emergency bond purchases, sudden policy clarifications, rapid changes in guidance. Those are signs of pressure, not confidence. This is where the global impact becomes visible. If Japanese investors begin reducing foreign bond exposure, increasing domestic allocations, hedging less against currency risk, That signals a deeper shift. Capital coming home doesn't make headlines, but it reshapes markets quietly and permanently. The yen will act as a pressure gauge. Sharp appreciation suggests carry trades are unwinding, risk appetite is falling, liquidity is tightening. Sharp weakness suggests policy credibility is being tested, capital confidence is fading. Either extreme increases volatility. Stability becomes the exception. Finally, watch how bond markets move together. When Japanese yields rise, and US yields rise with them, European yields follow, credit spreads widen globally. That's confirmation that this is no longer a local adjustment. It's systemic. Japan's bond market is not failing in the way crises usually fail. There is no sudden collapse, no emergency intervention, no dramatic breaking point, at least not yet. What is happening is far more subtle. A system that was designed to suppress risk for decades is slowly allowing that risk to return. And when risk returns to a market as large and as foundational as Japan's bond market, the effects do not remain contained. They spread. For years, global markets benefited from an assumption that was never written down, but always understood. Japan would keep borrowing costs low. Japan would absorb excess debt. Japan would export stability. That assumption shaped asset prices, risk models, and investment behavior across the world. It allowed governments to borrow more. It encouraged investors to take more risk. And it made volatility feel optional. That era is ending. Japan is not acting out of defiance. It is acting out of necessity. An aging population, rising prices, and currency pressure mean the country can no longer afford to protect the global system at the expense of its own stability. And when a stabilizer steps back, markets are forced to stand on their own. Some will adjust, others will strain, a few will break.